everybody. Welcome to the Sense of Things podcast. And we are launching our second show, which is a two-parter from our first show, where Ron and I covered a bunch of different topics. And we're going to finish the other two topics that we wanted to discuss today, because we felt like there was just so much information we couldn't do it in one episode. And we made you come back. Ron, how you doing, buddy?
Good, Jeff. How are things there?
Fantastic. I'm actually, there's actually sun up here versus where you're at. So
it's coming up, but just started to feel the summer weather here in the last week. So it's a good and a bad thing. So it's
good and bad. Yeah.
Like the warmer weather.
Yeah. So it's only 105 degrees yet at 6 o'clock in the morning.
No. Give it another month and a half. We'll be there. Definitely. It was 97 on Tuesday.
Woof.
Yeah, it was in the 60s the week before. So usually we get the turn about a month ago. We got it there in the last week. So
yeah, well, as Gary Shandling put it, who was from Phoenix, people would say, "Well, it's a dry heat," and he said, "Yeah, so's an effing blowtorch too, but I don't want to put my face into it."
No, don't get me wrong. You got to sip water all day, but I'd rather take that than sit in wind chill and deal with snow and ice and all the other good stuff.
6 feet of snow in Philadelphia. So yeah. Well, cool, man. Let's why don't we kick it off? Last time, we talked a little bit about some of the stuff going on in the stock market and things like that, and we were saving for today was a little bit more on the recession, kind of our thoughts around recession and then interest rates and where those are going and everything else. So I think I can probably kick it off. I know, one of the things that we're going to be doing on the show going forward is really focusing on, the first part of the show, really focusing on kind of what's going on, bigger macro, and then we'll focus on topics. So, I think the big macro items from this week, and certainly Ron, kick in where you see, but big macro items I saw this week were CPI and PPI,
absolutely,
which were down from the previous month, which is theoretically a good sign. The markets took it that way, but that also shows that we're moving very rapidly in the deflation area, which can come back and bite us a little bit. What's your thoughts?
Yeah, they some of the key people that I've been listening to, they're talking about deflation, they're talking about stagflation.
Yeah,
really, what it comes down to is with the PPI and the CPI, look, they're all lagging data indicators. The Fed is data dependent. So even though it didn't go up, you could almost say it was nearly flat. It's not a significant or a precipitous change to the downside. So there's still going to be at least another rate hike. I don't see how that we can avoid that anyway, because they still need to kind of, tap the brakes a little bit. So it should be interesting to see. But also with the CPI is interesting because they've tweaked that formula a little bit over the years, and same thing with the PPI. What it is interesting is it's an aggregate number, but you got to really parse it out. And some of the key parts of the CPI are going up.
Yeah,
they're not going down.
Yeah, I mean, I think the big ones, food's still going up, and housing definitely was going up. I mean, that was really what pushed it up. If you dug into the numbers, I mean, it was actually down in energy and everything else, but housing continues to go up. And that's becoming an affordability issue and an attainability issue for especially the younger folks.
There was one number I didn't realize it was calculated in the CPI, but because it stuck out like a sore thumb, they mentioned it. Because used car sales, used cars had gone up in value through the pandemic. That was one of the biggest numbers that came down. I think it was around 11 or 12%. Just used cars came down, and that's what they focused in on. I'm thinking to myself, how is used cars like a real indication of inflation? Even though I know they went up during the pandemic, but as an overall number on a quarterly basis. So, but a lot of the other numbers were still elevated, like you said. Food, rent started to stabilize and come down, which is a sign. So it should be interesting to see as we get more data, and more specifically, I know we'll talk about it, corporate earnings and guidance here over the next few weeks, just because they said to expect at least a 7% decline in earnings plus or minus from Q1.
Yeah. Well, and I think, the other factor, what we were talking about prior to the show here, I think the big factor is employment. If you look at the unemployment numbers, yes, you're hearing about all these layoffs and things like that in the big tech space. But, if you look at the year-long trend, I mean, since the pandemic, you had the big spike up in, unemployment during the pandemic. That came down, and it's basically just been kind of flatlined for the last year and a half at this point.
Well, look, our economy, for better or for worse, however you want to look at it, is based on the consumer.
Yeah.
2/3 to 3/4 of our economy is basically based on people spending money. Mm-hmm. So as long as people have jobs, they're going to spend money, even if it's at a higher cost.
Yeah.
So you're right, tech, we talked about that. They're always usually ahead of the curve, doing it earlier and deeper than everybody else. But when we start to see it hit manufacturing, retail, and keep going trickle down there, when we start to see tranches of layoffs there, then we know the cracks are truly widening. But like I said, I think we're going to see more of that starting Friday with bank announcements, and then going in the next 4 to 6 weeks with the real core of the S&P.
Yeah, and I think that's going to be interesting, because it's not actually normal for banks to it's funny because I was listening to some of the market pundits, and, they were talking about, well, this one bank reported and they didn't report what their deposits were. And I'm like, well, they don't necessarily normally do that. They talk about earnings and they talk about, their loan portfolios and things like that. They don't usually report, but I think people are going to be focused on that if they didn't report, they've got to be hiding something. And, they're not telling what their deposits look like. Well,
I still think, and I know a lot of other people do that, there's still another shoe to drop in the banking industry. Even Warren Buffett alluded to it yesterday morning in his CNBC interview. But even more so than that, and without kind of getting, certainly it's not a recommendation. Yeah. Since 2008 or 2009, I have continually had an issue recommending any bank common stock because it's a black box. It's a black box. And we don't know truly the risk on their balance sheet. And like you said, some choose to identify by the deposits. That's for auditors, right? Well, no, it's good to know your solvency and things like that. And with Silicon Valley Bank, they had $42 billion disappear within 24, 48 hours, and the majority of that was by 12 depositors.
Yeah.
Way too heavy to that one end of the boat, no doubt about it.
Yeah, absolutely. Well, and I mean, that's going to be a major factor for the regional banks because, I think that they still don't want to pay that well on deposits. So people are looking at alternatives. I think we alluded to it at the end of the last show, talking about money market deposits are the highest in history. They've never been this high. And, people buying into the treasury. I mean, why wouldn't you? I know we do that with our portfolios, and I know we discussed that last time. It's easy to put together a portfolio ladder, and I'm sitting here with a 1 year, with a 3 month, 6 month, 9 month, and a year long treasury ladder, and they're earning 4.5% risk free.
Or you look at it, the 3, 4, and 6 month that are hovering around 4.95. Yeah. Why wouldn't you just get in those, and when they mature, reevaluate? Just park the money, asset preservation, get that yield, and then decide at that point. And you know what? If we're wrong and the market goes up 5 to 10%, well, then you're up also.
I still make 5. Yeah.
In front of us. You can't ignore facts. It's not fake news, folks. You can't ignore these facts.
Yeah. No, and I agree. And, you look at the corporate rates aren't very much more than that. So why take the risk of being in a corporate when I could, be in a treasury, and I know I'm going to get my money back in, a year or 6 months or whatever it works out to be.
Well, if you think about it, right, there's a lot of people. Well, look, all investors have short-term memories, right? Yeah. What's the infamous saying? An optimist, doesn't have a short-term memory. It's one of those things.
Yeah.
But if you think about it, right? People were spoiled in the last 14 years. Interest rates were essentially near zero.
Mm-hmm.
Treasuries, that wasn't even an investable word.
Nope.
Now you're going back to where we were 30, 40 years ago, where you can actually park the money and get some yield.
Yeah.
There are people that I've talked to that have been in the business 30 years, 30, 35 years. This is the first time in their careers they've ever purchased a treasury in the last 12 months.
Which is amazing.
It's insane.
Yeah. Yeah. Well, I mean, and rates have been so low for so long, and it's amazing to me. And I think everybody's got to kind of change their game a little bit, or change their thought process of, well, traditionally I just haven't looked at government securities. It's like, okay, why wouldn't you at this point? At least you're going to get your money back, and you're getting a pretty dang good yield, quite frankly.
Yeah, and just to kind of butt it up, we're not saying it's a long-term strategy.
No.
It's a short-term strategy.
Yeah.
Look out 6, 9, 12, maybe 16 to 18 months. At that point, we're going to, 2024, 2025 should be pretty darn good years.
Yeah.
Especially 25.
Yeah. Well, I think, there's going to be a point in time that the Fed's raised rates for so long, they're going to have to shift the other direction, because they will slow the economy down. And,
it's interesting. All the people that truly follow it are like, we can't cut rates for a long time. But meanwhile, if you take a look at the Fed futures rate, they're anticipating a shortcut in Q3, Q4.
Yeah.
I don't see it happening.
No.
And you even hear from some of the Fed people when their communication blackout period ends, they're like, hey, we got to hold steady here.
Yeah.
We don't see it happening until next year. These are the people making the decisions, not the people that are betting on it. But I think what they're thinking is, if we are in a recession and things are bad, then they need to lower rates again. I don't see that happening in the next 6 to 9 months.
No, because I mean their focus is, and you have to listen to what they're saying. Their focus is getting back to 2% inflation, and I just don't think that. Yeah, I mean, it's going to take years for it to happen, because we took so much money for especially these last few years, and dumped it out there. I mean, there's COVID money that hasn't been spent at this point.
There's still PPP funds.
Yeah,
there are. When people brought that up to me a couple of months ago, I'm like, I don't even know if it's an active program.
Yeah,
you got to call the bank. You got to call your CPA. I would have assumed they had all been done a year ago.
Yeah.
But apparently there's still programs out there. And I don't know how people today can legitimately say, I'm still affected by the pandemic on a daily basis. Laissez-faire, let the market work itself out. But why the government would still be giving out money is insane. Yeah.
Well, and like I said, they've been so focused on program after program that's putting money into the economy. So it's just, the Fed and the fiscal policy are fighting constantly. It's like a battle back and forth. And until they can, the government can stop spending too much, or start looking at, okay, how do we slow that down? I mean, I just don't think the Fed's got that much chops to be able to slow it down, radically.
I know that we definitely don't want to go left or right, or really even center on politic conversation.
Yeah.
But you and I have talked about it. The number one goal of a politician is, right?
Yeah,
to get reelected.
Yeah.
Right? So if you're a politician, it doesn't matter, congressperson, senator, and you tell people, look, we got these programs out for you. It's free money, this or that. I think they're going to continue to get votes because people are sheep, unfortunately, and they don't realize the short-term good could be long-time bad.
Yeah.
And decades ago, politicians, better or worse, were more fiscally conscious.
Yeah.
Not in the last 15 years.
No, and it's the wild swings of, there's less in the middle. I think there's a lot more people in the middle, less politicians in the middle. And that's just that back and forth. We can't agree on anything. And yeah, I agree. I mean, you don't have as many politicians today that are saying, okay, let's just stop. And that's left or right. Because the other one blames the other one, and whoever's in power, it's they're spend crazy. Well, you're all spend crazy,
Well, not only that, but I guess it's a good segue. The debt ceiling, right?
Which
is sticking out there. It's looming, and it'll become more prominent after earnings season.
Yeah.
That's out there. Now,
Yeah.
I don't have a date on it yet, but it's like June, July. I don't know what you heard.
Yeah.
That's hanging out there. And that's summertime when a lot of the Congress, starts doing vacations, but they're not going on any vacations until they get it done.
Not this year.
The market's going to go down until they have an agreement, because if there's a shutdown, that's an easy 5 to 8% potential hit to the market.
Oh, right. Well, and a raise in interest rates too, because then the risk of treasuries and things perceived are, well, the government's not going to pay their bills, so interest rates are going to go up. So that has a trickle down effect into housing and mortgage rates and everything else on top of all that. And then of course the government's got to play their little silly games of, well, we have to close because of the debt ceiling. We have to close this half of this museum because we can't afford to hire people. Well, most of those people are not hired; they're volunteers. So,
right,
you're not paying.
Or if they're
for
getting paid, it's at paltry rates.
Yeah, exactly. So that little guy that's making $12 or $14 an hour as a docent, I don't think you're going to lose much. Or it's costing that much. Yeah, exactly. So, debt ceiling, I think my thoughts on it when I'm thinking about debt ceiling is, you've got the administration digging their heels in saying we don't want to negotiate. You got the Congress that's saying we're going to negotiate or we're not going to agree. And what's your feeling? I think it's going to be a knockdown drag out well into the summer.
I agree. As a matter of fact, I know it's going to sound political, but both sides do it to an expert level. I think it's going to be a closed vote. Mm-hmm. And the key people on both sides, and I'm talking at the Congress and the Senate, this is what they always do. They add the pork in. Well, if you want my vote, I need this, that, or the other thing for my constituency. Somebody told me one time, hey, Ron, do you work for free? And of course, no. Neither do the politicians.
Yep.
So if they're not getting something out of these bills, call it extortion. I know it's an extreme word. You call it whatever you want. But these politicians will hold out so they can get more money for their state or for their district. And it has nothing to do with the federal budget or the federal. No. I shouldn't say that. It doesn't have anything to do with the greater good of the federal government. It has to do with them. So they get more selfish. So instead of holding out and letting other people vote for what they need later on, wait a minute, I can hold them hostage until I get, if they want my vote.
Yeah.
This has been going on a hell of a lot longer than you and I have been around.
Wow. It's been going on since the beginning of our country, and it's been going on in every country. I don't think it's unique to the United States by any means.
No.
That they're trying to get hired by a very small group of people within a country, either in a congressional district or in a state. That's who they have to worry about. They don't have to worry about the American people in those cases.
And I get that, but the problem is you're holding up another 49 states.
Yeah.
You know what I'm saying? Or not just that one person, but this happens on both sides. If that truly does occur, and you get these, draw the line in the sand, it could drag out. It could drag out, and that would be even worse because that's just a pile on top of everything else.
Yeah. Well, it's leading into that second half of the year. So, I think the other side of the coin here is, one, we could see interest rates go up as a result of this, but I think inflation is kind of an interesting issue. Is part of this. And that was kind of two of our topics that we wanted to cover today was, inflation and where we see it going. And I think, I'm coming from the same boat. I think you are, that I see more stagflation than anything, inflation staying up there where it just can't come down farther. It can't come down to the Fed targets and the economy starting to stagnate, and we really haven't seen that since early 80s. Here. We've seen a couple periods, but nothing to the level that we saw in the early 80s.
Now, and the interesting thing is, and I'm an amateur economist like you are, we like to review it, digest it, overanalyze it like everybody else. But, in December, when I was doing like a 2023 market outlook, I had said in there, I'm hoping, inflation gets down to 4.5% or 4%. We're 6.5 or a little over 6 now.
Yeah.
They want to get down to 2.
Yeah.
That's not going to happen overnight. It's not going to happen this year. It's going to take a few years to get there. So you're correct. I agree with you about stagflation. But, one of the bigger problems is how does, the inflation or stagflation affect everything else?
Mm-hmm.
Well, something just came out in the last week. I know we were briefly talking about it earlier, that the banks are, have tightened their credit so much. They are not giving out loans and not giving out money. They have tightened it so much it hasn't seen these levels in 14 years.
Mm-hmm.
And if you look at the Depression, the Great Recession, and every recession, why are we in them? Well, forget about inflation. The idea is that the government always is pumping money into the economy. Why? Because we already talked about it. 2/3 and 3/4 is the consumer.
Yeah.
So if you stop lending out for homes, for home improvement, to buy houses, to buy cars, to expand your business, if they're not giving out loans for that, well, you don't get the expansion. And it's contraction.
Yeah.
And that's what the Fed wants.
Well, I mean, I can say it from a small business perspective. One of my businesses, I reached out to my bank and I was just, I'm like, hey, I want to increase my line of credit that I have with you guys, just, as a way of just having that little extra padding. And the interest rate they came back to me with, I laughed, then I went, no, I'll just keep what I have at this point at the rates that you have it, because I'm not going
to do it, but they're not going to do it at an attractive rate.
No.
So this way they can still say, hey, we're consumer friendly, right?
Yeah.
But if that's not a canary in the coal mine, I'm not sure what is. If small and regional banks have tightened it so much that somebody like you with really good credit, pay all their bills and everything else, can't get something at an attractive level, you're the poster child of who they would do that for,
or who they're supposed to do that with, and I think that tells me that deposits have been down, because I mean they can't, banks make money by taking your deposits in and then factoring that up, by using the Fed windows to borrow at really attractive rates so that they can loan it out to people. And, if they don't have the reserves on file to be able to do that, then they're going to start to raise the rates on, their borrowers and especially small business, which I think that's going to be some challenges, because a majority of people are employed by small to mid-sized businesses in this country. And so if you start tightening credit, if I'm a GE or a large company, I've got a lot of different avenues that I can borrow money and, or different avenues to capital. A small business, we don't have that. I can't go to the market and say, well, I'm going to put out more shares of stock. I have to find either an investor who's willing to invest in my business, or I've got to find a bank that's willing to let me borrow money when I need that for cash flow in my business.
And you kind of hit the nail on the head for one of the main reasons that the Fed has the tool to increase or decrease interest rates, because as I had mentioned, I think in the last podcast, the Fed rate is essentially an accelerator, right? You want the economy to go faster, lower rates. You want it to slow up, you get off the accelerator.
Yeah.
But the whole idea is it's slowing down the flow of money. That's what the Fed is trying to do. So again, if the small and regional banks, and I know the big banks too, but the small and regional banks aren't lending out, and that's going to that's going to make things come to a halt. The problem is that when people and or businesses, if you're a 2-income household and one person loses their job, well, you're going to want that credit as a just in case. If you both lose your jobs, well, now you're definitely going to need that credit. So if it's not available, again, that's going to have a cascading effect.
Yeah, well, it's they always borrow money when you don't need it, and I think it's already starting to be a factor for a lot of people that I can't necessarily borrow money, or I'm leveraging up my credit cards and everything else. So I think the last topic I know we had discussed and what I wanted to cover is, all right, so I think we've come to the solution that, or we've come to the conclusion that we are going to see a recession. What's your thoughts on depth, this time? I know this is just a guess on our part, but your thoughts on, is it going to be a sharp recession, a prolonged, drawn out, a little, tiny one like we saw a couple years ago? What's your thoughts on it?
I think you got to give 2 points of a backdrop to answer that question, because neither one of us really know.
No.
But I think there are really 2 points there. I think, if people keep sticking their head in the sand long enough, I think it'll be worse. I think if people prepare, people create that emergency fund, businesses create that emergency fund. I think if they stay ahead of the curve, that's fine. But to your point that you said before, if they stick their head in the sand, no recession, employment's good or whatever, I think it could be deeper. The second thing is, I truly believe if we just follow the normal course of an economic cycle, I think it could be a shallow recession. We come out of it Q4, Q1, and that'll be the time to really get in when the first negative GDP number hits in a quarter. But the second, obviously, as a major headwind, we don't know, is any geopolitical event.
Yeah.
So because that'll mess everything up. Throw the geopolitical event out, I think there's a 50% chance of a shallow recession. More people stick their head in the sand, I think it could be moderate to deep. What are your thoughts?
I kind of think along the same lines. I think it's going to be a little bit sharper than I think people are anticipating at this point. I thought the funniest thing was I was reading the Fed comments after the last Fed meeting. And there was a little mention in there that, well, we think there's a possibility of a recession coming. And I'm like, no kidding. Really? You think this is from the same people that said inflation was going to be transitory, but I personally think it's going to be a little sharper. I don't think it's going to be as long. I think it's going to be sharp and short versus long and drawn out, like we saw in 2008, because there was a massive freeze in the banking system at that point.
Also, nobody knew the bottom of it either.
Yeah, and that was it. I mean, so many things had occurred that you just didn't think were going to be possible. So it took a long time, and it was a massive issue with the real estate markets and everything else, which were really, if you look back to the 2008 recession and the market crash and everything else, I mean, you could, if you followed real estate, you could really see the cracks and the effects, starting in 2007, way before we were even in a market decline or recession. I mean, your area, California, your area out there in Phoenix, I mean, those had been just hot real estate markets, and they got just crushed really fast. And then that kind of led into a lot of the effects that were happening, where people were having foreclosures, and then that kind of fell into the subprime mortgage lending and a lot of what was happening with real estate investors out in California and all that. I don't see that much happening, from that systemic piece this time. I mean, yes, I think real estate prices have gone through the roof, but I think they're correcting back down. I don't believe we have as much subprime that we had. You don't have as much securitization of the mortgage securities. So from that systemic part, I don't really see it. But I just think we're kind of running into a massive headwind, and I just see that kind of hitting hard and fast. I mean, I guess the good thing is the Fed has been raising interest rates, so they've at least got themselves back and reducing their balance sheet to where they've at least got the ability to have something to fight back when that happens.
Yeah, I know quite a few HR people in my business network, and to me, they're a good canary in the coal mine indicator too, because the interesting thing that I've heard from them versus a year ago or 2 years ago is the following. They're not laying off as much, but they're not aggressively hiring.
Yeah.
And I think that's a big difference there, because if they're not keep trying to add and they want to maintain, that may be the crest. right?
Mm-hmm.
That may be
Yeah.
kind of like the top end to say, okay, we're fully staffed right now. All right. Maybe, we'll replace a B person with an A person, however they may want to upgrade personnel, but
Yeah.
they haven't gone through major retrenches yet.
Mm-hmm.
And I think we'll start to hear some of that in the corporate earnings announcement in the next 4 to 6 weeks. But I talk to my HR network every month just to kind of get a little bit of a pulse from them on what they're hearing and seeing, especially the recruiters.
Yeah.
It's very interesting. The real quick switch that I'll wrap this up, where many staffing companies, their requests are more for temp people than it is for a full-time hire.
Yeah.
Because they're just trying to cover maybe an overage of business for a period of time and demand, but they don't want to commit to them in a longer term for benefits and whatever else it may be.
Well, I mean,
I think that trend is just starting to inch up.
Just as you said that, I just kind of quickly pulled up BLS.gov and looked at the JOLTS report. And I remember, I think the last time I looked at the JOLTS report, which is, for those of you that don't know, it's the Job Openings and Labor Turnover Survey. So it's kind of the indication of the open jobs that are out there. And I think the last time I looked at it, it was actually around 11 and a half, 12 million. And I'm looking at it currently, and it's down around 9 at this point, just slightly under 10.
Historical average there?
Historical average. So it's interesting. If you look up to 2020, it traditionally ran around 7,500 or 7,500,000 jobs. That's been kind of the traditional, and it slowly kind of goes up over time. It spiked up after the pandemic up to around 12,500.
Right.
That was its peak, and then now it's come down to about just a little under 10. So, I mean, we're still historically, job openings wise, way above where we have been. But I think what's happening, though, is you're seeing there's a ton of job openings that are part of that are jobs that, people are like, oh, I don't want in the, in the fast food industry and all that. I think hiring on that lower end,
that good stuff,
all that low end stuff, there's tons of jobs there. I think, my personal belief is a lot of those higher end jobs have gotten scraped off, at this point. And it really is that, hey, we're just going to replace, we've only got openings for a temporary, for, a contract of 6 to 8 months or something to finish a project out versus, hey, we're hiring for long-term growth at this point. So I think that for me, is that canary in the coal mine that it could be it confirms to me that there's the chance of a recession is pretty good, but two, seeing that come down, seeing that number come back down to kind of what I would consider getting into the normal range again, I think just tells us that we're going to be in a situation where people are, if they've got their heads in the sand and they're not protecting themselves, preparing for a recession, I think they're going to get a rude awakening when you start to see manufacturing jobs lost, service industry jobs lost, things like that.
Well, just the fact that it went from 11 to 9.
Yeah.
I'm not going to, look, one data point isn't a trend, but certainly that's a drop.
Yeah. Well, I mean, that's basically,
drop. It's not like it went from 11 to 10.8.
Yeah. It peaked at 12.5 and at the beginning in January of 2022 and January of 2023, which is the last, they just reported the February number, which was 9.5 at this point. And the previous number was just a little over 10. So that tells me that that's coming back really fast at this point, and most likely it's the higher end, more expensive jobs that are getting cut at this point. Because I still drive around town here and see all the retail and what I would consider the minimum, not minimum wage, but kind of that low end wage. There's everybody's hiring at this point, and they can't find people.
Not only that, but you probably see it in Austin just like I see it here, and I'm heading back to Philadelphia next week.
Yeah.
The restaurants are still full, not just on Friday and Saturday nights.
Yep.
Sundays, Wednesday, Thursdays. still pretty packed. A lot of happy hours, right?
Yeah.
So the restaurants are still pretty good.
Yeah.
It's amazing how much, I don't know how much their food costs have gone up, but I know they definitely have replaced their menus with higher prices a few times in the last couple of years.
Absolutely. It's funny, I got back from London, and we'll stop after this, but I got back from London, and it was so funny to see the difference. I mean, I'm used to, here, if we go out for two of us for a lunch, I'm going to write a check for $50. No matter what restaurant I go to. And I mean, we were eating.
That's without an alcoholic beverage.
Yeah, without alcohol, just lunch menu type stuff. We typically don't go out for dinner. And I mean, I'm used to writing a $50 check. And, we were in London, which is one of the most expensive cities in the world. And I mean, we were eating most times for 25, 30 pounds at decent restaurants, and so exchange rate wise, it's about $30-$35. And
it's funny. Very, very, very quick segue on talking about London with Europe.
Yeah.
Believe it or not, many of the European countries, their markets are at near or all-time highs.
Yeah.
They just started pulling back, and they just raised interest rates. Mm-hmm. So it's kind of one of those things. They always said, when the U.S. sneezes, everybody gets a cold.
Yeah.
I think our sneeze is finally getting around the world here.
Well, it is.
I think when we start to see Europe, because usually they're ahead of the curve with us as far as not just seeing inflation, dealing with inflation, but increasing and decreasing of rates. Mm-hmm. They're usually ahead of us. So we'll see what happens there.
Well, it's interesting because I remember you remember a few years ago where rates were actually negative in the European countries. I mean,
German Britain.
Yeah, you actually had to pay them to take your money, which I still never understood how that worked. It made no sense to me, but apparently it worked in their minds or whatever. But yeah, I just happened to, I was looking at economic statistics today, and I noticed like the German CPI, where ours was at 5 or 5.6, German CPI is like 7.7%. Right now. So, I mean, they have to raise rates. I mean, they have to do something to slow this down. And I think the contagion is starting to spill over, from our pricing and, which affects material costs and everything else. I think it's starting to spill over into the rest of the world. Although, Canada and Australia have stopped raising rates at this point. So I think they're kind of realizing, okay, we got to slow this down before we kill our economies.
Last quick data point, because I can't confirm it, but I did hear it last week from somebody that's usually in the know. We're complaining about $4.50, $5.50 for a tank of gas.
Yeah.
Europe, Germany, I think it's equivalent to like $10 to $12.
It is. Yeah. It's like seven something a liter when we were over there. Correct. And I'm like, a liter is a lot smaller than a gallon, guys. So there's a couple of those. So it's equivalent to it's like $12 over there.
Yep. So with their inflation, how many people are taking, going cross country? I don't know. But that's going to have a trickle effect too. If you're paying more for gas, then you have less money for other things.
Yep. Well, and you got to get trucks, and they don't have the ability to do as much as we do from a rail perspective. I mean, they don't ship as much by rail in England and across Europe. They use mostly trucks to do that because they just don't have the big rail capacity that we do.
And diesel ain't cheap either.
No, it's even more. So, well, good, man. I thought this was a good conversation today. Thanks for your time. I know you're getting ready to hop on a plane to head to the Great White North. So
Northeast.
Or Great White Northeast. So yeah, although I heard that the temperatures are actually going to be pretty nice, so you should have a pretty good trip. But
in the high 60s, low 70s. Looking forward to it.
My favorite. So well, cool, dude. Thanks a lot, folks. As always, we're publishing these right now once per week, and we're doing these mostly live initially, so that we can get it out to the audience as quick as possible. But make sure that you subscribe to the channel wherever you're listening to this or watching it. We're on YouTube and we're on all the major podcast channels. Thanks a lot for your time. We look forward to seeing you back here next time.